Hi, this is Jeffrey, Graph Financial. So we're going to do a bit of forensic analysis, balance sheet. I think you're going to love it. Okay, so let's look at that. And let's start with the, since the year 1999. It's going to be very interesting. This is the balance sheet of Beijing Airport. So 7 billion renminbi in assets. Okay, so what do we have here? What is interesting? This was liabilities, equity was at 3 billion and then increased at 6.7. That means they issued capital. And why did they issue capital? To do a capex? Not really, and we're going to see why. Because the long-term liabilities plunged from 4.2 to 1.68, and that's at the same time. There is a corporation that we're going to discuss. It's controlled by the Chinese government. Reduce their stake. So basically, this Chinese SASAC state-owned enterprise decided to IPO some of their shares, and they did reorganization of their capital structure. Okay, they used to have a lot of trade payables. That I don't know why it changed so much. I put that. I could look at that, but it's not so relevant. So this is the net debt. Look at the net debt. We're going to look at the net debt in history. Net debt was back then, before they do the IPO, minus 3.4. Okay, so 3.4 net debt, and then plunges with the IPO, and then they grow their net cash position significantly in 2007. Why did they grow? Was it due to cash? Maybe. To their cash flows back in 2007, just before the Olympic Games in Beijing. And then they sizably increased and refurbished the cash flow from operation. Was not that big. So we're going to have to investigate a bit later why they managed to decrease their net debt so much into a net cash position. All right, let me just make sure that I have that proper. Yeah, they increased their net cash position. We're going to have to figure out how come they increased their net cash position so much, because that doesn't match the cash flows. Well, so it's one aspect. All right, so then they took a very sizable amount of debt in 2008 and 2009. The sales went okay in 2008. Despite the financial crisis, the sales in 2008 were basically not so much of a problem. They increased from 2.4 to 2.8 billion. Now, there was a tiny blip. Look at that. 2003, there was a blip. And 2003, you had the SARS, the ancestor of COVID. And SARS is a much bigger risk than a financial crisis, apparently, because if you look at that, from 2008 to 2009, the total revenues actually increased here. Whereas with SARS, they had a blip down. So pandemic and airports really don't like each other. So let's come back to the balance sheet and look at this net debt situation. So they increase a lot because, well, guess what? Look at that. You see the property, plant, and equipment. It boomed. It's actually boomed. So how did they finance that? Did they finance that with the equity? Well, no, because you see this amount barely changed a bit. Share premium, he did issue a bit of stock, but not so much. It's mainly this is share capital increase only slightly, and the debt side increased. Loans from parent company, which is the government-related SASAC company, increased. So the loan from now they're gone. Okay, so this loan from the parent company increased. Then they had a lot of trade and other payables. That's probably payables on the construction, because This is completely out of whack with the traditional level of payables related to their operation of airports. Okay, now what happened? Loans from parent company, we talked about that. Okay, non-current liabilities, let's look at the current liabilities and let's look what happened. Payables was basically payables as trade payables converted into short-term borrowings, okay, and current portion of loans to the parent company, this one which then declined. So a lot of trade payables were actually building this huge expansion that you can see in this change in property, plant, equipment. Now the property, plant and equipment is going down. While this is depreciation, I don't think that it reflects that the life of the airport is shortening and it's going to go to zero because the value of the company of the airport goes to zero. They have very long lives. It's just the depreciation. And that tells you what? That tells you that the cost of rebuilding today is unlikely, completely unlikely to be the carrying book value. Now, if you look at the other intangibles, right of use is basically some sort of prepaid expansion. They bought that. Phase 3, where is it? Phase 3 right of use, but it's not very big and it's quite depreciated. So this right of use asset is not very significant. So what happened is you have here the net debt, as we mentioned. Let's look at the net debt, the cash minus all the debt, went from a sizable amount, then IPO to deleverage, and the government lowers their stake, and then they do a huge expansion, and you have minus 20.8 net debt. So 20.8 billion in net debt, okay, back in 2008. Where are we today? Because right now everyone is concerned about the pandemic, and we are going to show that in another, with other data, that the fuel, jet fuel, is coming very quickly. So this is after the, you can see that after the 2008 expansion for the Olympic Games, net debt went down, 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 down. And then what happened is that it bottomed in 2009 and then increased again because of the situation with the COVID. Here we're going to have to analyze the second airport which went online in Beijing in September, and we have to look at the second half of 2019 to see if there is any reason to believe there is overcapacity outside of COVID. Okay, we're going to look at that. All right, but if you look, we have the full year on the income statement for 2009, and the full year 2019, sorry, and full year was actually a decline. We don't know if it's the capacity impact of the second airport or if it's just December, which was such a plunge. All right. So the revenues, total revenues, had a slight dip from 2018 to 2019. How much is due to the stop, total stop in December, because it started to stop in December? How much is due to the capacity expansion with the second airport? We have to figure out. All right. So now let's look at the net debt. So it increased. Sorry about that. Balance sheet. It increased back with the COVID, okay, and the sales actually totally plunged. Now, the plunge and started to recoup this year. So the point is, the interest payment were much higher back in post-COVID. If you look at the interest expense, total expense, other income, financial cost, look at that. We have back in 2011 post-expansion, the expense were 729,161, okay? And now with much higher rates, we are at 331, so the expense has increased Not so much. The question, are they covering? Well, unless you have a pandemic, it's very likely that this company is going to go bankrupt, given the profile of their sales and their position as prime real estate. You only have two airports. Now let's look at the statement of operating cash flows. All right, so operating cash flows, this is what's going on. All right. So this is, you have 2003, which the SARS, have a bit of a dip. 2001, I don't explain myself what happened. I have to dig a bit. So 2008, well, lots of costs were passed into the income statement. They were building the airport and some costs were stuck in there. All right, so that's the operating cash flows before the change in working capital. You can see that this company was in 2008 building. The thing was kind of a drag. Not on the sales, just on the cost. We saw the sales that were not going down because of the 2008 crisis at all. And the cash flows continue nicely, and then boom, they plunge with the COVID, totally plunge, minus 1.1, minus 1.1, minus 1.9, and 2023 back in the green before the changes in working capital. So the changes in working capital, so they lose on cash flows because of change. Why? Because you have to understand that when the economy plunge and the sales plunge, working capital is actually generally cash back, and when you expand again, you have the opposite effect. That's why you have here, if you look at that, you have in the plunge year, the operating cash flows plunge before working capital, plunge more than after working capital adjustment, which is different here. See, this is 2019. Operating cash flows after change of working capital are lower than before change in working capital. All right? So as they grow again, this is eating trade receivables. See that? Trade receivables, they have to finance the trade receivable. Whereas here, in the plunge, they get cash from the trade receivable. See that? All right. So that's why, but then next year, once you have provided this working capital cash, next year we will show the 6-month results year over year. They're going to come soon. But they were already discussing by the end of year 2023 that so far in the first 3 months they were accelerating. So this number is going to be positive. I believe we are going to cover interest cost again this year easily, probably in the 2 times. And then we are back to normal in terms of traffic. I hope this was interesting. Thank you very much. Bye-bye.